This is Guns and Butter.
There's something happening here. Yeah. What it is ain't exactly clear. There's a man with a gun over there.
And so I've personally witnessed the regulators at our agency being instructed by Washington under this new Reinventing Government Movement that we were to refer to banks as our clients, and we were to think of them as our clients. And I, not being a quiet type, stood up and objected and said that our clients were the United States of America and the people of America. And they said, no, that's not correct. Right? Under new Reinventing Government initiative, the client was the banks.
I'm Bonnie Faulkner. Today on Guns and Butter, William K. Black. Today's show, The Greatest Bank Robbery Ever. William Black is Associate Professor of Law and Economics at the University of Missouri, Kansas City. He is a lawyer, academic, and former bank regulator, and author of The Best Way to Rob a Bank is to Own One: How Corporate Executives and Politicians Looted the S&L Industry. The title of today's show was taken from the title of Martin Mayer's book, The Greatest Bank Robbery Ever: The Collapse of the Savings and Loan Industry. And according to William Black, the current crisis is 70 times larger. I caught up with Bill Black in Rimini, Italy, at the first Italian grassroots economic conference on modern money theory produced by Italian journalist Paolo Bernard, which featured speakers Stephanie Kelton, William Black, Marshall Auerbach, Michael Hudson, and Alan Parquez. William Black, welcome.
Thank you.
We're here in Rimini, Italy for the first Italian summit on modern money theory, subtitled How to Stop the Plundering of Italy of Our Incomes, of Our Rights, and of the Future of Our Children. What are your thoughts before the beginning of this grassroots economic conference? It will be held in a stadium here, and thousands of people are expected to attend.
Yeah, it's an amazing thing, isn't it, for regular people to want to hear from folks about economics and pay their own way, not supported by any NGO and such, just people concerned about their nations. So we're very excited, and nothing like this has happened that we're familiar with, so we're curious as well how the whole thing was going to work out.
Well, yes, that's right. I mean, here we are in Italy. Are you aware of anything like this having taken place in the United States?
No. The Occupy movement, of course, is a different type of thing that's had teach-ins, and I've done teach-ins in L.A. and in New York City and Wall Street, but this is very different, very authentically Italian.
Well, I'm going to be anxious to get your opinions when this is over with. This is a 3-day conference here at the end of February. Why don't we start with the banks? Are all banks malevolent? What's the difference between Goldman Sachs and a local bank?
Certainly not all banks or bankers are malevolent. Some of them do very useful things for the world. But overall, finance has really lost its way. And it's lost its way in a fashion that isn't simply wasteful, it's immensely destructive. So the whole theory in economics, as we teach it, as to why these banks are supposed to exist, the whole theory is that the bank's just a middleman, right? The banks are supposed to take all of our savings, accumulate enough money so that they can do something useful with it, make a big loan to a company that allows them to come out with a new productive investment. More people get employed. It's all good, right? That's the theory. That's the middleman function. So middlemen shouldn't be very big, right? And they shouldn't make a whole lot of money. The whole efficiency principle for a middleman is they're smaller and they don't make very much money. And they're helpful. And that all of our emphasis should be on the real economy, as we call it in economics, that actually produces the jobs and the useful things. That's not the world we live in now. The world we live in, finance has become the dog instead of the tail. And finance in the United States, for example, takes, depending on the time period, 30 to 40% of all profits in business. Now think of that. They've become a parasite. And as a parasite, they always weaken the economy. But it's worse than that, because they also engage, and this is many of our most elite institutions. So your question goes to precisely the right point. Why is it that our most elite institutions are our worst institutions? The ones that time after time violate the law and cause our recurrent intensifying financial crises. That's what we study. That's what we try to get people to change policies so that we don't have these recurrent intensifying financial crises.
Regarding the global financial crisis of 2007, what is money manager capitalism?
Well, people use that phrase in different ways, but it's mostly precisely what I've been talking about. Capitalism was typically a theory of how you created a real economy that had real jobs and did real things. Nowadays, we do less and less of that, and we do less and less of that, in particular in the United States and Europe. We have created finance as an absolute monster, a parasitical monster, and one that also periodically throws us in the ditch, a big chunk of the world in the ditch. So in the U.S. alone, in just the household sector, that's you and me, the losses from this crisis were $11 trillion. A trillion is 1,000 billion. But we're an incredibly rich country. We're one country with a sovereign currency. Europe isn't those things. Europe is rich, certainly, compared to the rest of the world, but it doesn't have its own currency. It doesn't have a single nation state. And what you're seeing is a reaction to this crisis that has made it far worse. And it's become essentially a core versus periphery, where the core European nations are becoming increasingly furious at the nations on the periphery, like Greece and Spain and Italy and Portugal and Ireland. But it's the nations in the core that have in very large measure created the crisis. So the bigger the crisis they create, the more they blame the victims of their crisis, and the worse they make the crisis.
With regard to banking and finance, do you feel that there is something inherent within the socio-economic system of capitalism itself that it inevitably leads in this direction to financial speculation, etc.? Do you think that that is inherent in the capitalist system?
Yes, but, and here's the important but, pure capitalist systems don't exist anywhere. And they don't exist anywhere for very good reason, that they do put you into the ditch, and they throw lots of humanity aside, and they produce elite criminals. So you get crony capitalism, not real capitalism. And conservative economists, like Adam Smith, have recognized this from the very beginning. So they've always said you need government involved. Right? How much government's involved, huge disputes. But they've always emphasized government has to be there, and they've always emphasized one key role for government, and that is the government enforcing the law. Right? Not just against people using physical force to steal, but against fraud. Even Ayn Rand emphasized that the government was essential to stop businesses from using fraud against people. And what's happened over the last 30 years, and it's happened particularly in the United States and in mainstream Europe, was that got forgotten. there was a new breed of economists. We call them theoclassical economists because it's a religious dogma that said, no, you have to get the government out of everything. And so really extreme views have become the dominant views. The leading law and economics scholars in corporate law have now taught a generation of lawyers who've gone on to be the key decision makers that a rule against fraud is not necessary or even particularly important in securities markets. See, markets just automatically exclude fraud. If you could just make the government disappear, there could be no fraud. Now, that's a view that has no basis in reality, no basis in any sound economic theory, contradicted by all human experience. But it wasn't a view just held by a whole generation of lawyers. It was held by Alan Greenspan, who there's a really wonderful Frontline documentary, The Warning, about the warning that the chair of the Commodities Future Trading Commission, obscure agency, but one that's supposed to deal with financial derivatives. And she warned that this was going to produce a disaster. Alan Greenspan, then chairman of the Federal Reserve, and a host of Democrats and Republicans in the Clinton administration and the supposed Republican opposition at that time, got together to crush her. And they passed a law, the Commodities Future Modernization Act of 2000, that forbade us to have any regulations, even against fraud, in particular kinds of financial derivatives, which are now $65 trillion in size. And Alan Greenspan said that we must not have regulations of these because fraud is no basis for governmental intervention, because markets just automatically exclude it. Right? This is insanity of such an incredible level that only expert economists could believe it. And, of course, propound it as if it were truth.
And I remember that was President Clinton that signed the bill, I believe, at the end of his last term.
Absolutely. And it was with the active support of Treasury Secretary Rubin and then his replacement, Summers. And, of course, President Obama brought back Larry Summers as his principal economic advisor.
Well, Bill, you've probably already answered this next question, but I was about to ask you if you could talk briefly about the Clinton years, the deregulation of the financial sector, the speculative bubble and its significance. Well, what about the bubble that this created?
Well, the bubble doesn't really emerge in the Clinton administration, but it's appropriate to focus on the Clinton administration in terms of deregulation. So if I could just go back to the years just before the Clinton administration to do some setting. In 1990 and 1991, under the first President Bush, all good things in terms of fraud started in Orange County, California, in the United States, and it started again in Orange County, California, was the making of these fraudulent liars loans by savings and loans. And we were the regional savings and loan regulator, and we said this is insane. This has to produce huge losses and fraud, and so we stopped it. We killed it in the savings and loans, which were federally regulated entities. So what happened? The leading maker of liars loans, who, by the way, didn't just specialize in making liars loans, he specialized in making liars loans where they sought out minorities and the elderly to do this too. Gave up his federal charter, gave up federal deposit insurance, converted and became a mortgage bank for the sole purpose of escaping our regulatory jurisdiction and going to an area where the federal government didn't have regulatory jurisdiction. And then proceeded, of course, to do all of these frauds, was eventually sued by 49 state attorney generals and the Federal Trade Commission, settled for hundreds of millions of dollars in penalties, and was promptly named the U.S. ambassador to the Netherlands.